So, here's the key. What do we do with our money going forward? And I want to specifically say, if you're investing in the stock market, it's typically for the long term. You're building some sort of core and satellite approach. Stop trying to time the market. If you can time the market, show me your model, because I will give you my money if you can constantly outperform. But the reality is you won't. Private equity, venture, here's the deal there. Again, focus on asking better questions. One of the downloads that I had last week when I met a few founders in the healthcare space, we were talking about the business space and what to essentially get out of each business meeting you have. And one of those things came in the form of a download, hearing new information and things that'll stick with me, is asking better questions. If you keep getting these ping pong responses in the traditional questions you're asking any asset manager or asset owner, whatever that is, whether it's a multifamily real estate project or a fintech, healthcare tech, whatever business that they're in, ask better questions to where you can actually get a pause.
Yeah, and
from that person that you're talking to.
And two questions that we talked about before. Well, let's say three is, again, who the hell the operator is, and what's their past, right? You got to understand their cash flow statement month to month. How are they? What's their capital stack look like? Timing and at what cost? And the third one, which is why we do this in every one of our deals. Does a crash scenario underwrite out to a net positive, right? And thank God our deals do. We have that 20% crash scenario in there. And if we make a 5 to 8% margin, we proceed. So we know our downside has some room. Now we get the 25, 30% corrections, we're probably in trouble, right? Or we have to pivot. But to your point, the better questions matter. And those three questions you should always be asking in your own due diligence in your deals.
Due diligence is the utmost important. Know who you're dealing with. I always say this and I stress this. I personally do that. You want to know exactly who is behind managing those assets, managing your investments, and really thoroughly understand the individual, understand and see what their options are in the event that these, I'd say tail risk events that occur. How are they going to manage out of it, right? I think that is extremely important in finding those companies and investments that have optionality and that can actually make pivots to what the original investment was and perhaps what the market is now giving them. Can they make money in that scenario for you? Yep. So also curb your expectation. If you're seeing high teens and low 20s, IRR for these real estate, curb your own expectations, but also you might want to go back to the folks actually putting the deal together and grill them on those numbers. What you just said, Look at those scenarios where we've got a 20 or 30% correction, right?